All right, I'm here with Drew Brenner with Origin Point Mortgage, and he's here as an expert in the industry to help correct maybe some misconceptions based on the news we've heard recently about a rule change that affects mortgage interest rates for different borrowers and different down payments. Now, if you're like me, you've heard kind of two sides of this. The one side is that it's helping borrowers with maybe lower credit scores and lower down payments out to make the home more affordable. The other side we've, I think, all heard is that it's penalizing higher credit score borrowers. And both takes are misleading, I think, as I've learned through speaking through this in depth with Drew. And he's here to just really get down to the brass tacks of what this means for a couple different borrowers. So we set up a scenario, Drew, where we're talking about a $400,000 mortgage. So go ahead and lay out two borrowers that we're going to profile to show how it would work with the old setup and with the new setup.
Okay. That sounds good. And as he was saying, there are the two sides of that story, and honestly, both to an extent are true. So before we jump in really quick, I wanted to mention that before the adjustments to the rate, there was 740 and above was the top tier. Now they've added a 760 and a 780 tier. So if you're in those upper tiers, the hits to the interest rate based on almost any down payment are still pretty low. But now if you're at the 740 tier, which is now more a middle tier, those hits have definitely increased. As he mentioned as well, the hits for the low down payments as well as lower credit scores have also gone down. But I want to caution everybody that having a higher credit score is always better. So don't go out and do anything crazy, miss a payment to lower your credit score thinking you're going to get a better interest rate, because that's not how it works. So let's jump into our example.
Okay, so again, $400,000 home purchase, and the two areas we're looking at is a 700 credit score with 3% down, you know, maybe FHA loan, or is this conventional?
No, this is still conventional. It only applies to conventional loans.
All right. So, and that's, I think, a good point. Let's be clear that this only applies to conventional loans, not FHA or VA.
Correct.
So, with a 700 credit score borrower with the old system, kind of what rate would they be seeing?
So if they were doing 3% down on 700 credit score, then the old system, they would probably be seeing, based on today's rates, about 7.5%.
Okay.
But with the new system, still having that same 700 credit score with the low down payment, it's dropping all the way down to about 6.99%, at least based on where rates are today.
Okay.
So that's a 0.5% difference in rate, which is about $132 less per month that particular borrower would be paying.
So that's basically their phone bill and maybe Sling TV that they get for free. Okay. So I mean that's no chump change. That's significant.
That's considerable.
Now let's jump up to. We're not going to discuss necessarily the upper tiers, but let's stick with that 740, which usually used to be the top tier.
Yeah, they used to be a really good credit score.
Okay. So let's go with the 740 credit score. What did it look like then, and what does it look like now?
So for a 740 credit score in this example, we're going to go with a 15% down payment, because Fannie Mae did increase a lot of those hits to the interest rate in those kind of middle down payment ranges. We'll call them 10 to about 20 to 25% down. So with a 740 credit score, the old way, that person based on today's rates would have a 6.5% interest rate. But with the new interest rate hits, it's jumped all the way up to 6.99%, which is about $111 per month difference in that monthly payment.
Okay, so it used to be that for the lower credit score borrower with a lower down payment, they would be about a full percentage higher than the higher credit score buyer with the higher down payment.
Correct.
All right. But now the interest rate at least is about the same. So that means a net monthly payment lowering for the lower credit score borrower of $132. So they're saving about $132 a month. For the higher credit score borrower, they're actually paying about $111 more per month. Now, the overall monthly payment is not the same, even though the interest rate's the same, right? Because one has a 12% higher down payment. So the higher credit score borrower with the higher down payment is still going to be paying less, but it's not as low as it was in the old system, right?
Exactly. And the other thing we want to look at too is the PMI, the private mortgage insurance that you pay anytime you put less than 20% down. And it's done as a percentage just like the interest rate, and that percentage goes down the more your down payment increases. So yeah, that 15% down borrower is going to definitely be paying less PMI than the 3% down borrower as well, even though the interest rates are about the same.
Okay, so Is there an incentive to having a higher credit score?
Yes, there's always an incentive to having the higher credit score. You will always get a better rate having a higher credit score at any down payment amount.
And have you heard the question of a borrower saying, maybe I just miss a payment or two, or take out some credit cards to lower my credit score down? And have you heard these sorts of questions?
Yes, I've actually heard that a few different times, even as recently as just last weekend. And so, again, I want to tell everybody, don't go do anything like that. It is always better, no matter what your down payment is, to have a higher credit score. So it's really beneficial to make sure you have a good loan officer that's going to help you navigate what different down payment percentages are going to get you different interest rates.
That would be you.
Yes, that would be me. Versus as well as the PMI, the mortgage insurance that you pay based on those different down payments. So I can go through all the different options with my clients, and we can figure out the best kind of bang for their buck to get them in the best position moving forward.
Perfect. So it does benefit you to have a higher credit score, to be responsible with your money and your credit and payment and everything like that. It's just not as much of a bonus as it was.
Correct.
Okay. So still be very mindful, be very cognizant, be a good steward of your finances, your credit score. Pay attention to the length of your credit accounts. Don't take out a bunch of new credit cards or get new loans. A real easy one is getting a new vehicle right before you're looking for a house. Not a good move. You want to wait till at least after you close on that. So be good stewards of your credit score. Go for the highest credit score possible, and you still benefit from it. Just you don't benefit as much as it used to be.
Yep, unless again you're in those really high credit score ranges, 760 or 780 or thereabouts.
Okay, and we'll go over that next time and see what the benefits are there.
All right, that sounds good.
All right, Josh Winkler, Drew Brenner with Origin Point Mortgage. Until next time.
Thanks for having me on, Josh.
Of course.